This video is called The Math of Winning in Trading. And there's a whole lot of losing in trading right now. So let's go see the math of winning in trading.
In this video, we're going to break down some of the basic mathematics of winning in trading. Here I've put $500 on black on roulette. I'll show you the outcome at the end of the video, but in the meantime, I'd like to break down some basic mathematical theory in relation to trading financial markets, using this roulette spin as an example of probability theory. Considering about 80% of my audience are not profitable traders, I think many of you are going to find this particular video very helpful in better understanding what constitutes an effective trading strategy. You don't have to understand this theory in order to be a profitable trader, but every profitable trader exploits this theory, whether they know it or not. As you'll see later in the video, I'm not promoting gambling. In fact, I'll make a very good case on why you shouldn't gamble. But in saying that, if this bet wins, I'll donate the money to charity. None of the material in this video is financial advice. I'm experienced in managing my own finances, but I'm not qualified to give anyone advice. Deep down of what we're going to cover in today's video, there'll be timestamps below. First, let's cover the mathematics of expectancy. Basically, the interplay between our win rate and our risk-reward ratio is what determines our expectancy. Expectancy is how much we can expect to make per trade on average over a sample size. So for a trading analogy, let's assume we have a 50% win rate with a risk-reward profile of 2 to 1. So for every trade we lose $1. For every trade we win $2. So with a 50% win rate, 2 to 1 risk reward, if we were to risk $100 per trade over about 100 trades, we should expect to make about $5,000. Assuming we have fixed risk reward and fixed risk per trade in dollar amounts. This formula doesn't consider slippage, commission drag, or compounding. In most cases, we're not.
Yeah, Rick is mentioning he watched this a couple days ago. In fact, I think, Rick, I got it from you. If you guys ever want to send me videos to look at, go over to the Chris's upcoming video ideas and drop that in here. Yeah, Rick, it was your suggestion. And in fact, I was looking at the comments and somebody said, the internet's the most awesome invention I've witnessed in my life because she gives you access to information like this, right? I saw a lot of really positive comments. I'm like, okay, let's watch this video.
Not going to be risking $100 per trade. We're going to risk a percentage of our account balance, which will grow our risk proportionate to the growth in our account balance. So that positively skews our expectancy over time. And also don't forget tax. Tax has a big impact on the profitability of a system. These are things traders don't typically consider, and they wonder why their system's profitable on paper, but when they go to trade it, they're not making money. We need to consider these factors when we're developing systems. Now, most trading systems typically don't have a fixed risk reward profile. Some do, but most systems have a dynamic risk reward. So trend following systems, for example, they're not going to have a fixed risk reward. However, this is
and I'm glad you mentioned that because in a game like roulette, right, you put your token on whatever, and then you have a 1 in 29 chance or whatever the case is, right? So you know exactly how much you'll win and exactly how much you'll lose. And depending on where you place it on the board is how much you'll win or how much you'll lose. In trading, we have no idea how much we can win, but we should know precisely to the dollar approximately how much we're going to lose. Precisely, approximately. Yeah, I know I did that. But we know we're going to get out at a certain level, right? We know we're going to get out at a certain level, right? And that's why I tell you all the time, there's 4 possible outcomes: a big win, a small win, a break even, or a small loss. There should never be a big loss. That should never, ever be a possibility in your trading. Now, because of this, we do not have a fixed risk return, right? In an open trade scenario, a trade can run dramatically. A trade can go crazy. In fact, what I like to say is cut your losers short and let your winners run out of control. That is the mentality you need to have in trading, right? So I'm glad you mentioned this, right? There is no assumed fixed risk to reward in trend trading.
Systems have a dynamic risk reward. So trend following systems, for example, they're not going to have a fixed risk reward. However, this isn't financial advice, but in my early days when I started trading back in 2017, so about 7 years ago now, I started in late 2017, the thing that turned my trading around and took me from being a consistent loser to actually being consistently profitable for a few months in a row was trading a fixed risk reward system. I was shooting for 2 to 1 risk reward. I had a win rate of about 40-something%, and I made money about 3 or 4 months in a row, and it was a huge breakthrough for me. Now, some of my systems in the Forex markets still use fixed risk reward profiles, but most of my systems have dynamic risk reward, and I no longer stick to that. But in the beginning of my trading career, this really helped me. Understanding this math, applying it to my trading systems is what turned my trading around and gave me that breakthrough from being a consistent loser to actually making money. So don't underestimate the power of fixed risk reward profiles, especially if you're struggling as a trader. Executing a system with a fixed risk reward instills discipline, It instills confidence, consistency, most importantly, and just instills good habits in your trading. You don't move your stop loss, you don't move your target. You're just always shooting for that fixed risk reward. In my experience, in my own trading, that is what helped me cross the threshold from struggling as a trader to being profitable. Understanding the mathematics of expectancy also helps us to understand why risk management is so important. So let's apply all of this to my little roulette spin at the start of the video. So American roulette has 38 pockets, 1 through 36, and 2 zeros. It has 0 and double 0, so 2 green on the wheel. If you're betting on black or red and the ball lands in one of the zeros, you lose. So this skews the probability. It's not 50-50, like some people might think. Betting on black on American roulette gives me a win probability of about 47%. So it's not a coin toss. That's the house edge. The only other form of gambling that comes close to this sort of win rate is blackjack. That's the only other game where the house edge is slim. Other than poker, obviously poker is a totally different bag of worms, for lack of a better word, because poker, you're not competing against the house, you're competing against other players. So of all forms of gambling, poker has the most in common with trading. But to keep things simple, I'm going to stick to this roulette example. So if I were to bet on black on American roulette, I'd have a 47% chance of winning. So my expectancy would be negative $5 per every $100 I spend. So at best, if I'm really, really lucky over a long sample of bets, I'll leave the casino down $5 for every $100 I've bet. And that's assuming that I get lucky and that I don't encounter a losing streak, which we'll get to later. This is probably the best odds you'll get in a casino outside of Europe. The reason I say outside of Europe is because in Europe, the roulette wheel only has a single zero. So we still have numbers 1 through 36, but instead of 2 zeros, we have 1. That skews the probability of winning positively by a small fraction, but it counts. So betting on black on European roulette gives me a win rate of about 48.6%, which is a little bit closer to 50-50. And my expectancy is now losing $2.70 per $100 bet versus $5. So that's a pretty big change in my expectancy simply by choosing a different game to play or different variation of the game. I'm not telling you guys to gamble. This should be an anti-gambling video, if anything. By the end of this, you should not want to gamble. You should want to stay away from casinos because you'll better understand the house edge. But if you're going to gamble, like I did for this example video, you got to be smart about it. Being a better trader has made me a better gambler. For one, I don't gamble very often at all. And if I do gamble, I know when I'm lucky and when to quit and when to leave. But anyway, all of this is to say, trading is a lot like gambling. It's a lot like gambling, except we as traders can have the house edge. We can be the casino if we structure our trading appropriately. So moving on, another important concept to understand as a trader is when it comes to risk reward profile, you pay for what you get. So here is a simulation of the expectancy curve by Nick Raj. This was on one of his blog posts a while back, and it's in one of his books. This shows the inverse correlation between win percentage, so win rate, and risk reward profile or win-loss ratio. So you'll see here that if you're shooting for a 5 or more risk reward profile, you are typically going to encounter a win rate below 20%. The more profit you shoot for, the more likely you're going to lose. This is just basic theory. If you're shooting for a really long, far away profit target, but you're managing your risk and constraining your risk, so you have a really large profit target, but pretty tight risk, you're going to hit your risk way more often than your profit target. That's just simple probability theory. And so be prepared for that. Be prepared for that. Ideally, we want to be around this range here. Somewhere between 40 and 60% is a pretty good range. If you shoot for really tight risk reward, and sure, you can get a 70+% win rate, but the robustness of that system can be fragile because we really, really depend on that win rate. We really need to be correct way more often than we're wrong in order.
And that specifically to that point is why selling options is so insidious. Selling options is a very insidious game because it's the allure of 80-90% win rates potentially. But when you're wrong, you now have 8-10 trades in a row you need to make up for that. And imagine you take in a random distribution, you can actually get 10 wrong in a row. In a random distribution, that can happen. Now, imagine that happens in your trading on a 90% win rate. And you get 10 wrong in a row, you're hosed. Your account's gone. It's over. It's so over. Now, can that happen? Yeah. Is it likely to happen? Unlikely. But you need to make sure that your risk return is in balance. Excuse me. And so I like to share my returns from last year. Now, I would love to do this again this year, and I don't know where it's going to turn out this year. And that's another thing too, is that I'm not setting any expectations. Can I do this again next year? Absolutely, because none of these trades happened until May. Not a single one of these trades happened until May, and we're in April right now. So can I do this again next year? Or I should say in 2025? For sure. But I don't know if I will. And in fact, I could double or triple or quintuple what this is. But for me, my expectancy is 7.69. meaning that every trade I put on, I have an expectation of winning 7.69% returns. And every single trade, I have an expectation of a return of 7.69%. My win rate before November was over 80%. But my average win to average loss was not all that different, right? I don't have any average wins that are 10 times greater than my average loss, but my win rate was so high that that's how we had these giant jumps last year. And every single one of these trades, every single one is over in the Discord in the Outlier trading room. And you can go see for yourself every single one of these trades, every single one, and what it did to my portfolio, why I got in, why I got out. You can even watch the YouTube videos on every single one of these trades, right? Transparent as it can possibly be. Now, with the Outlier 3.0 signals that are going to be coming here in the next couple of weeks, honestly, this may be chump change. These returns at 91%, these may be chump change here in a minute, which I'm very excited about. Man, I can't wait for that to come through. But this is what my returns are. And this is why you need to keep data. And this is why I can confidently trade, is because I have done this since 2021. I can look at my data every year and say, okay, I see exactly where my expectancy is. I see exactly how much my edge is. And it's also helped me figure out when selling options was a very losing strategy for me, a horribly losing strategy for me. And because of having this data here, I can confidently go into any trade knowing that I may not win every time, but on the whole, I'm pretty confident that I'm gonna come out ahead.
To turn a profit with a inverse risk reward. Personally, depending on the system, I shoot for at least a 0.9 risk reward profile with a 60+% win rate. Some of my mean reversion systems have a 60+% win rate, but they rarely take more than 90 cents for every dollar I risk. But that's profitable. As you'll see later, I have some spreadsheets you can play around with, plug some of these numbers in and see the expectancy and the win rate, how all of these numbers interplay with each other. And then we have trend following systems, which are closer to the 40% range. But now we're looking at 1.5 and above in terms of risk reward. Now, this is a rough theoretical estimation of these numbers and how they interplay with each other. But in my experience in the past 6-7 years of trading, it's pretty accurate. The rule of thumb is the more profit you shoot for, the higher your risk reward.
Okay. Let's use this, right? So I ended the year around 70%. So at 70%, I actually need less than 1.0 on the win-loss ratio here, which is pretty much what we got here. Now that's just to break even. Of course, I did a lot better than break even, but isn't that interesting, right? That's how the math plays out.
The lower your win rate is going to be. There's just no way around that. And it's just a matter of preference and personality. There are really great ways to make a lot of money with a high win rate and a small risk reward. And there are great ways to make money with a large risk reward and a low win rate. If you can stomach the lower win rate, I personally find that an easier way to trade because you're not so dependent on wins. If you can stomach a lot of losses, a lot of small losses, then shooting for a large profit of 2, 3 to 1 really isn't that difficult. The hard part is sticking with the system during the losing streaks. But making the system itself profitable is a lot easier, I find, when I'm shooting for a higher risk reward. But the cost is you're going to lose more often, you're going to be in drawdown more often, and that is not tolerable for a lot of traders. Now, technically speaking, on this graph here, anything that falls beyond this line on this side is profitable. But in my experience and from all the literature I've read on trading psychology and just general human psychology when it comes to pain tolerance, there's been a lot of studies on how losing and winning affects human psychology. And many human beings struggle to play any game where they lose 40% or more of the time. You can overpower that. You can overcome that. I have to a large degree in my own trading. For me personally, I am all in on the idea that if it makes money and it's robust, then it can be traded. I really don't mind. But I have to admit, it is more comfortable to trade systems that win more than 40% of the time. As you go down the win rate ladder, it gets stressful. It does get stressful. The drawdowns last longer. Technically, you can.
And there's more pressure. There's a lot more pressure, right? If you're on a 30% win rate system, in my opinion, that's a lot more pressure. Like, oh man, I better not screw this one up because this could be the one, right? If I screw this one up, then how many more trades do I have to get to another opportunity? I don't know. That's a lot more stressful to me.
Potentially make more money on this end of the spectrum because you can shoot for larger reward, but the pain to achieve that reward should not be underestimated psychologically. So this is just something that's worth factoring into system design and development. So let's talk about losing streaks. Losing streaks are always a risk in trading and they cannot be avoided. Please don't try to avoid them. Drawdowns.
Exactly. And this is exactly precisely what happened to me right here last year. November was my only losing month of the year. And it was right after the elections. I got caught in this move, and right here, I got in. I won a couple, but I lost more than I won as it came back down, and I had to close a lot of trades because they hit my stops. And that's okay, right? Whenever you put on a trade, you know ahead of time how much you can win and how much you can lose. And so I wasn't too miffed about it. But you also don't throw it like it's house money, right? This is my money. I ain't giving it back. I am not giving it back. But a lot of people, when they get returns, when they start to actually see money in their account, they're like, you know what? This house money. I can play with it. I can gamble it. It's all right. No. You treat every dollar in your account as if it's yours. And when you start respecting those funds in your account, you're going to treat them differently than if you're looking at it like it's house money.
Are inevitable. We affectionately refer to losing streaks as traders as drawdowns. I say affectionately, a bit tongue-in-cheek. None of us like drawdowns, but they are the cost of doing business in the markets. There is no way around them. Even Warren Buffett experiences drawdowns. The best traders on the planet experience.
I'm in a drawdown right now, if you can believe it, for 2025. Like the market is in a huge drawdown. Hang on, we're loading up my 25 results right here. Yeah, the market is getting absolutely monkey hammered. So my returns, I've put on only 4 trades. Only 4 trades have set up so far this year. I had a winning January, a winning February, and a losing March. And that's okay, because my account is in a drawdown of 64 basis points. I mean, it doesn't even measure on here. Where the SPY, as of when this was calculated, was down 13%. So my alpha is very strong. My returns compared to the market are pretty strong right now. Plus, when you only have 4 trades, you don't have enough data to really base anything on. So even though like all of this looks terrible right now, I'm not even miffed. I'm not even concerned because I have the data from last year that gives me that confidence. What percent of my trades are in options? Like 100%. 100% in long, deep in the money options. Around 21 days to expiration. Vince says, house money. That's literally your house. Damn right you treat like money with respect. Yeah, but people don't. That's a real thing. People think, in fact, there is an old adage that says, if you want to be a millionaire trading stocks, start as a billionaire. Because they treat it as if, hey, I've got house money to lose. It's no big deal. You don't need to ever consider it like that. Consider that money in your account, even if you've won it, even if you've made it out of the market as your money, and treat it with respect as if it's the same money that you worked, that you went to your job, that you gave up time from your family, that you had to sacrifice for and scrimp and save for. You treat it with that same respect, you're going to be better off than you would if you treating it like house money.
Drawdowns. You cannot get around them. Don't even try. It's a fool's errand. You will not succeed in getting around drawdowns. Sure, there are ways to mitigate them, to minimize them, but you cannot avoid a drawdown. So don't go looking for that system that never encounters bad drawdowns, because you'll be looking forever and you will never, ever find success as a trader. The real question is, what kind of drawdown can you stomach, and structuring a trading system around that number. So for most traders, it's around 10, 20% of their capital is about the maximum of their comfort zone. I tend to be a bit higher. I can stomach around 30, 35%, but that's because I'm a lot younger.
Bro, I'm telling you, if I had lost 10 to 20% of my capital, I would not be a very happy camper. That would really keep me from sleeping at night. That would make me really step back and say, what am I doing? Why am I doing this? I'm doing something wrong. That's a big ask. And for this particular person to say 30% he's comfortable with, I don't think so. I don't have all that much hair left. I don't know if I'd have any hair left if I had a 30% drawdown. Like that's a big deal. That's a really big deal.
Younger than some traders, I have a lot more time to work with. You know, unlike my parents are looking to retire soon. They can't stomach a 35% drawdown in their net worth, because that will screw up their retirement. For me, I'm happy taking on more risk if it means more returns over the long run, at least for the next 10 years or so. I know I don't look it, but I'm currently 34 years old. So, you know, I've got a good 10 years of high risk trading in me before I think I would need to start reining that in a bit and protecting my capital a bit more. That's a luxury I have. So with all that said, it's important to understand that even a 90% win rate in trading can theoretically still lose 100 trades in a row.
Yeah, that's what I was saying earlier. Even with a 90% win rate on I can't even think of the word I was thinking of earlier. A random distribution. On a random distribution, you can randomly have 100 losers in a row. It sounds crazy, but it's the truth.
Now, this is astronomically unlikely. It's practically impossible, but it's not literally impossible. the chance isn't zero. There is still an above 0% chance that with a 90% win rate, you could lose 100 trades in a row. Now, you would be the most unlucky human being in the history of the planet, but it's important to understand the theory behind these numbers and to understand the importance of risk management. 90% is a win rate no one can achieve. But even 60%, most traders get a false sense of security and confidence, thinking that just because they win more trades than they lose, then the chances of them encountering a really bad losing streak are so unlikely that they don't plan for it, they don't expect it, and this can be a lot of traders' undoing. So I have a spreadsheet here. There'll be a link to this below in the video description. Using the core probability theory mathematics, we have a sample size of 1,000 trades here, and this table here represents the maximum theoretical losing streak over the sample size. Here's the formula for how I'm calculating this table. Again, I got this formula from Nick Raj, and it's based on probabilistic theory. So this formula is good at estimating losing streaks over large sample sizes. It really just gives us a ballpark figure, a realistic, reasonable estimation of the kind of losing streak we can expect to experience with that win rate at some point. I also have this expectancy spreadsheet, which I'll explain more about later. I've inverted my screen here to keep this dark because the presentation is dark. But if you make a copy of the spreadsheet, there'll be a link below. You can play around with these numbers up here and see how different risk-reward ratios and win rates and risk per trade affect your edge and money management outcomes. The lower the sample size, the lower the chance of the losing streak, because we have such a small sample size that the chances of a bad losing streak occurring are reduced. But if we have 1,000 or more, even with a 90% win rate, we could lose 3 trades in a row over 1,000 trades. If we go up to 1,000,000 trades, now that number jumps up to 6. So you can see to get this to be 100, I don't know what number we would have to put in here, but it would be pretty big. So the chances are minimal, but they're not 0. And so with 1,000 trade sample size and a 60% win rate, you can expect at some point to lose 8 trades in a row. That is not an unreasonable expectation. That is within the realms of reasonable probability. And so be prepared for that. If you're risking 2 or 3% per trade, can you stomach losing 16% or 30% of your capital when this losing streak inevitably occurs? If you can't, then you need to lower that number. You need to be a bit more conservative with your risk. And if you've only got a 50 or 40% win rate and you're risking 2% per trade, you are going to encounter a 50% drawdown before you know it, almost certainly. So that is the importance of understanding the math behind all of this and structuring your trading and your risk management plans around this knowledge. I'll leave a link to this spreadsheet below. But let's move on. There's a few more things I want to cover. One of the last things I want to mention here is the theory of gambler's fallacy, or the Monte Carlo fallacy. The gambler's fallacy is the belief that past random events influence the probability of future events. And this is simply not true. And we'll go over some examples of this before we wrap up the video today. But for example,
so this is a key tenet in trading in the zone. Trading in the Zone is one of my top 5 favorite trading books, and it's all about trading psychology. And to that point, it's the outcome of the next trade has literally absolutely zero input from the trade that you have on today right now. The trade you have on today right now has absolutely no bearing in the outcome of the next trade. And also, on the other end, the last trade that you put on, win or lose, has absolutely zero bearing on the trade that you put on today. Meaning that the participants in that trade are not the same. The symbol could be completely different, right? Anytime you transact, the likelihood of you and I transacting in the same buy and sell situation is practically zero. And to that point, price is always going to be different. Parties are always going to be different. So there's no possible way that trade A will have an outcome on trade B, and that trade B will have any outcome on trade C. And C is absolutely not outcome based from B or A, because they're all independent. Every single one of them is an independent, unique circumstance. All trades are unique. I think it's exactly what he says. I say all stocks are bad. Trading in the Zone, Mark Douglas would say all trades are unique, because it's absolutely impossible that your previous trades or your future trades will have any bearing on them whatsoever. But when you get on a roll, you feel like you're the reason, right? You feel like, hey, you know what? I'm such a genius. Everything that I put on, and it just wins, right? I got the Midas touch. And that's where people start to take those trades that they wouldn't have taken otherwise, right? That's when they get in this gambler's high, and they start thinking, well, I won on the last trade, so I'm going to win on this trade. And then they size up bigger than they mean to, and they may win that next one. And then they do it again. And then they lose 3 times as much as they would have otherwise, because they didn't follow their plan that they had set out originally. And B, they let the outcome of a previous trade determine how they would act on the current trade, right? I love trading psychology. I don't know if you can tell. So this is great. I love this.
For example, let's use the roulette example. In roulette, if the wheel lands on black multiple times in a row, some people might believe that red is due. And I laugh at that because I know people, including my own family, that have fallen victim to this belief in the casino before, when I've been there with them and they've thought, well, look how many times black's come up, red's due. I've given up trying to explain to them that it's not, because it's a buzzkill. No one wants to hear that when you're at the casino there to have fun and gamble. But it's important to understand this, especially as a trader. Just because you lost 10 trades in a row does not mean that the 11th trade has a higher chance of winning. Now, it is true that the 11th trade might have a very low chance of being a losing trade if your win rate is high, but that chance is constant and it doesn't.
Exactly. I'm glad you mentioned that. The win rate percent, all things held equal, if you follow your same strategy, whatever, every single time, the win rate percent does not change from trade to trade to trade, right? Each trade has an equal chance of being a winner or a loser. You don't know the outcome of what it's going to be. And so to say, oh, I've lost 5 in a row, I'm due for a winner. No, that next 6 trade has just as much of a probability as being a winner as a loser as every previous one before that.
Doesn't change just because you had 10 losing trades in a row prior to that. It's important to understand that each event in probability is independent. And we'll go over some more examples later. But where this term came from, the Monte Carlo fallacy, the gambler's fallacy, came from the Monte Carlo casino. This is also the term for Monte Carlo simulations. I already did a video on that, so go and check that out if you're interested. But back in 1913, at the Monte Carlo casino, the roulette wheel landed on black 26 times in a row. And gamblers lost millions betting on red, betting against the recent outcomes because they believed that red was due. Now, this was on a single zero European wheel, so the odds of black were about 48%. The odds of black coming up 26 times in a row with a 48% chance was 0.0000004%. So that's pretty bad luck for the people who kept betting against black. That's very, very bad luck. You can't avoid this. That's the thing. Sure, it came out 26 times in a row, and you didn't know that that was going to continue for 26 spins. The odds of that were really, really low, but the odds were constant. Each spin had a 48% chance of coming out black. And a 26 spin sample size is tiny. If we go back to my spreadsheet for a moment, and let's copy this out, paste it here. Let's change this to 48.65. So we have a 48.65% chance over 1,000 spins. It is not unlikely to see red or black come up 10 times in a row. And you can imagine at a casino, spinning 1,000 times, they probably do that or more spins a day. So people that work at casinos, the dealers, would see this happen quite frequently, or more frequently than the average gambler. So some of you may be asking, and I've thought this myself when I learned about this theory, I thought, wouldn't it mean if the chances of losing 100 trades in a row are so slim with a 90% win rate, and you encountered a 100 trade losing row, doesn't that by definition mean that you'd be statistically closer to breaking the streak with a win? And the answer is no, you wouldn't be. This mistaken belief is the gambler's fallacy in a nutshell. And it takes a little bit to wrap your head around it, but let's break it down in more detail because this is something a lot of traders really get hung up on. And it leads to really bad habits, bad decisions in the market. It leads to chasing losses and all sorts of silliness. I mean, some of you would have heard of the martingale strategy, which dictates that you should increase your risk with each losing trade. This is the exact reason why you should not do that. That's a bad strategy. Sure, you might get lucky from time to time, but over a large sample of trades, that is a losing strategy and a very dangerous one. Because the gambler's fallacy is the mistaken belief that if something happens more frequently than normal during a given period, it will happen less frequently in the future, or vice versa. So for example, if you flip a fair coin and it lands on heads 10 times in a row, the fallacy is believing that the next flip is more likely to be tails to balance things out. But in reality, the coin still has a 50% chance of landing on heads or tails, regardless of previous outcomes. Each bet or event, like a coin flip or a roulette spin or a trade, for that matter, is independent of the previous ones. So if you have—
That's what I mentioned earlier. Every single event is completely separate, 100% independent from every prior one and every future one.
A 90% chance of winning a bet, the outcome of previous bets doesn't change that probability. The odds of winning or losing each individual bet remain constant, no matter how many times you've won or lost before. So how does all this apply to trading? Here are a few key points. First, losing streaks are inevitable. Drawdowns are inevitable. Accept it, embrace the suck. Don't try to fight it, don't try to avoid it. There's no way around it. When you're dealing with probabilities, as we do as traders, you are going to encounter losing streaks, no matter how good you are at trading, no matter how often you win. And that is why risk management is key to successful trading. No matter how good you get at trading, there is always the danger that the next trade will be a loss or the next 10 trades will be losers. And if you don't manage your risk properly, you are going to blow up. Understanding all of this will motivate you to be a better risk manager, which will, in turn, make you a more profitable trader over the long run. It also should encourage you
See it's really funny. Points 2 and 3 on here are what we talk about constantly. Trading risk first, right? Making sure you keep your losses small and then sticking to your plan. Dude, you guys have seen it. I see in the Discord almost every other day. Somebody says, hey, what should I do? And I say, well, what was your plan? What did you plan to do? Right? I'm not going to tell you what to do. You should have already had a plan. If you don't already have a plan, you need to get out immediately and figure out what that plan is for the next trade. Like when somebody asks me, hey, what should I do? I really don't like it because first off, I'm not in the business to give financial advice, even though I'm just a random guy on the internet. What I am in the business of telling you to do is come up with your own plan and then follow the plan. I'm not going to tell you what to do. You need to know what that is well ahead of time.
You to stick to your plan because you don't know what the next trade will be, regardless of recent trade outcomes. I know it's tempting to think you do, but you don't. You really don't. The markets don't care what your last trade's outcome was. That's the best thing about trading. It's not personal. The markets are not personal. They don't care about your situation. They don't care about your financial situation. That's why it can ruin you, and that's also why it can make you rich. It does not discriminate. The only discriminating factor is the money you have at risk, leverage, things like that. It doesn't care if you're poor. It doesn't care if you're rich. It doesn't care if you can afford to lose the next trade or not. It just doesn't care. It's going to keep going on, keep randomly moving as it does over time. And now, sure, the markets aren't entirely random, or else we wouldn't be able to develop an edge over them as traders. But there are so many factors influencing a market's movement that just because we can exploit its movement using trading edges and trading systems doesn't mean we can guess accurately what the market will do next. So in other words, we need to avoid emotional trading. You are not due for a win. And likewise, you are not due for a loss. Just because you've had a bunch of winning trades in a row doesn't mean the next trade is going to be more likely to lose. That's why I'm such a big fan of systematic trading. I like systems where I just press the buttons and the system does the work. Because whenever I get involved with discretionary trading, especially back in the day when I traded crypto during the 2017 bull market and the most recent 2020 bull market, emotions really played a part in my decision making. There were many times where
So discretionary trading, meaning it's at your discretion. Oh yeah, this looks like a great idea. Go. I'm gonna buy here, and then what's happening? I don't know. I'm gonna get out now. Right. First off, that's almost childish. That's almost like the most immature way you could possibly trade. And ironically, there have been market wizards who trade solely based on discretion. And there's probably somebody on the YouTubes who also trades based solely on discretion. And they don't have a plan. And when things go sideways, or really I should say when things go down, they just say, oh, buy more. Buy more. It has to go up from here, right? That fallacy. This, you know what? I think this is a perfect example of how we can relate this to so many different stocks lately, like AMD. Let's relate this to AMD, right? So many people on the YouTubes are telling you buy AMD because historically it has gone up in the past. What has it been doing now? It's been going down. So many people are saying buy SoFi. SoFi is a great example. So many people screaming, you got to buy SoFi. It's going up. It's going up. It's going up. It has to go up from here, right? And then it's going down. This is actually why we look at charts, is to say, hey, you know what? What is a more likely outcome to happen right now? That it will continue trending in this direction, or a more likely outcome of, hey, I found the bottom, it's going to go back up, or more likely outcome of I'm gonna ride this trend while it's trending upward, right? So many people have said buy Tesla because it recently went up and it has to go up again. This is real. This is real. This is why the market cycle exists. This is why the market cycle exists, because people do this, right? People do exactly this. And this is the text, this is the history book of all of these people in the market saying buy or sell. And it results in charts that look like this, charts that look like this, charts that look like this, charts that look like this. Right? We were talking this morning about how you can average up and get the same average value as you would on the way down. So, man, I'm loving this video. This is a great video.
I thought I need to take profit because this can't go up anymore, and it would go up another 50% overnight. And then there were times towards the end where I thought, wow, this has gone up so much, it's probably going to continue going up. I should keep my positions on, and I end up losing 20% of my open profit or more in some cases. That's because of my emotional decision making and things like gambler's fallacy creeping into my thought process. So we need to understand probability theory. Even a high win rate will encounter losing streaks. Be prepared for it. Understanding all of this can help you to know and trust your edge. If you don't understand and trust your edge, you won't be able to execute it consistently, and you will not find consistent profits as a trader.
But You need the data. You can't just arbitrarily say, I got a 70% win rate. I got an 80% win rate, right? What do you actually have? You don't know that unless you're keeping accurate records. Unless you consider it this way, right? Trading is not a hobby. Trading is a business. It is the greatest business in the entire world, in my opinion. But if you're running a store, are you keeping records of the inventory that you're buying? Yeah, of course. If you are running an accounting firm, are you keeping track of everybody who's walking in that door and what services you're doing for them and how much you're going to bill them? Yeah, of course. If you are a guard at maximum security prison, do you have records for every inmate and where they're supposed to be and at what time they're supposed to get out of solitary confinement? Yeah, of course. If you are a sprinkler repairman, do you keep records of how many parts you have on and how many parts you need to go get next week at the store and how many appointments you have booked up? Yeah, of course. So why would it be different in the way that you trade? Why would you just willy-nilly buy, sell, buy, sell? Oh, this is so much fun. And then at the end of the day, I wonder what my win rate is. No, bro, you should be knowing that to a T. You should be knowing exactly how your trades are going. You should be knowing exactly why you get in, why you got out, and have a record of all of this. Because this is a business. If you're doing this as a hobby, as something fun to do, bro, you plan on losing everything because you're not going to take this serious enough to survive. So if you aren't already keeping detailed records, you need to start today. You need to go back for everything you've done in 2025 and make that spreadsheet, make that journal to keep up with what you've already done. That way you'll know what you can do in the future.
Yes. Oh, there you go.
So you double your money?
Yeah, let's go on to charity.
Nice.
So in summary, each trade we take is independent of any previous trades. Short-term outcomes are random, so expect pain, expect drawdowns, and don't try to avoid them. Instead, plan for them, mitigate them, manage your risk, keep your risk constrained in the context of your system. So it depends on your win rate, depends on your risk-reward profile on average. We don't always know these numbers statically, but we need to have a good understanding of what to expect over a large sample size. So we need to be thinking in terms of blocks of 100 trades, at least 100 trades, if not more. Think of the next 1,000 trades. What is likely to happen over the next 1,000 trades? And a lot of this information we're not going to be able to know unless we backtest. And that's something I'll go into more detail in future videos and put together a whole course on when I get time, at least for TradingView and the strategy tester, which is a complex beast to wrap your head around. But through the process of sound backtesting techniques, Monte Carlo simulation, which we'll get to later, and I've done a video on that previously, and just developing robust systems that can withstand losing streaks, which can withstand the randomness of markets. That is how we deal with drawdowns. We don't try to avoid them. That's a losing game, and it leads to bad habits, bad decision-making, bad trading psychology, all kinds of dangerous pitfalls. So accept drawdowns and understand your edge intimately. That is key to good trading. Understanding these numbers and how they affect your edge over the markets is really important.
But you're not going to know that unless you're keeping records.
Important to having confidence in the system and being able to execute it consistently. Most traders fail because either they do not have an edge over the markets or they have an edge that works, but they don't understand it well enough to have confidence in it, to trust it, and to withstand those losing streaks that inevitably come along. Any of us who have been trading for any length of time all know traders who system hop from system to system. They encounter a losing streak and they think, oh, this system doesn't work, or it's not as good as I expected, and they move on to the next system when that system could have been profitable. Consistency is key in trading, and sticking to a consistent plan is the only way to measure your results and improve them. So take the time to backtest and develop a system that you understand and respect and trust, and then stick to that plan for some period of time, at least 100 trades. Personally, when I was learning, I stuck to at least 100 trades, and then I would do it quarterly. I would say, for this next quarter, I'm going to follow my plan note for note without deviation and see what happens. And then if it doesn't work after that quarter, then I'll readjust, I'll reassess. But I made money in that quarter, and I've made money most quarters ever since. Now, I have a losing quarter here or there, but over the long term, I generally make money because I understand my edge, I understand these numbers now, and I have good trading psychology as a result. So check out my previous video on Monte Carlo simulation.
So this is a fantastic video. Absolutely fantastic video. By the way, let me introduce myself real quick. We still have quite a lot to go through today, just so y'all know. Let me introduce myself real quick. Once I find the slide, I'm just some random guy who can't remember his name. There it is. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where Outlier is like a safe time, make money, and start winning less risk together as a team. So go ahead and subscribe if you haven't already. Now, I want to shift gears a quick minute and look at the member highlight of the week because it's Friday. And you know what happens on Fridays? We do our weekly winner circle. Now, what the wide world of sports is a weekly winner circle? Well, over in our Discord, we have a section called Share Your Big Wins. And over here, we want to hear from you about how you are using Outlier to make more wins or to avoid some losses. So let's look at a few of these from this week. Let's scroll up just actually let's start here. So this is a post that I put out there, and I said, so on a stress level of 1 to 10, how are you feeling today with the market crashing? And 1 is ultra chill, 10 is ultra panic, and the 1 on there is when I had to create this. Right, there were a couple people feeling 7s or 8s, but most everybody's between 3 and 1. Like no stress at all. And that's because hopefully you've listened, and hopefully you've told other people about Outlier and what we're doing. And hopefully you are also one of those people with no stress while the market's crashing. I hope that so much, right? But share your big wins. Let's scroll up here. We've got Deep Thought, who's here on the live stream. Not huge in value, but awesome in percent terms. How much was that? 1.83%. Way to go. Dude, you should be really proud of that. Nate says back in cash and super glad about it. KS Fresh made 24% on his puts. Hill Crime is super glad he's in cash in his brokerage and 401k. Let's see. Jim S says glad to be in cash both in his personal and retirement accounts and waiting for the golden ticket trading strategy to unlock. Let's see here. Simplify guy. I used Outlier to avoid throwing money away this week. Sitting in cash till the bleeding actually stops is the way to go. Made a few bucks on some small moves through Outlier, and specifically some stuff Chris recommended, like Colgate, but mostly just avoid losing money was what Outlier taught me, and boy, do I appreciate it. My big win is beating the S&P in the first quarter by using Outlier and keeping a big chunk of cash. And this is awesome. We have hundreds and hundreds and hundreds of these kinds of stories over and over and over. Like Brian had 168% overnight gain based on the Outlier setup in yesterday's show. You're welcome. That's awesome. Way to go, Brian. You guys are trading way more than I am, and you're winning way more than I am. And that's what I'm really excited about, right? Even though I'm locked out for the way that I trade, that doesn't mean that there's not opportunities for you to take. And I'm so stoked that you're sharing all of these opportunities with us, right? I get to feel like I'm Yoda and you guys are Luke Skywalker, right? This is great. So for our weekly winner circle, what we do is I get a name of everybody who has posted this week, and it's too late. You can't do it. You can't make up for it. I've already got the list. And we're going to do a quick raffle. Laurent UK won last week. And so we're looking at 25 names this week, from Bluefin Trader to Wes, to Nate, to Santiago. And so we're going to go from 1 to 25 over on random.org. We're going to say between 1 and 25. Pick us a random number and who's going to be our winner. And we're going to see number 2, which is Deep Thought. Congratulations to Deep Thought. You are the winner this week. And so April is going to send you a $10 Amazon gift card just for doing this. Just for putting what happened for you over in the Share Your Big Wins this week is our weekly winner. Congrats to you. And April, like I say, she'll shoot that over to you on Monday. So outstanding work for everybody involved. And I am really, really stoked that you're sharing these stories with us. Now, I'll also be very excited to tell you, starting Monday, we are going to have a viral sharing contest. I'll give you a quick preview. Let me see. OVTLYRD. There we go. See if it's propagated yet. Yes. Okay. So this is something we're very excited about the launch of Outlier 3.0. Now, we're going to be giving away $1,000 and a free year of Outlier to the winner of this contest. Runner up will get a $200 swag pack plus my 5 favorite trading book bundle. And then the second runner up will get a $150 swag pack plus my 5 favorite trading book bundle. And this will go from Monday, the 7th, I believe. Yeah, the 7th until midnight, 12:50 or 11:59 p.m. on Thursday, May 1st, and then the winner will be announced that Friday on the live stream here. Now, to enter, there's going to be a lot of steps, right? We want you to share this as much as possible. Every time you do one of these things, you'll get another entry. So, for example, visit the YouTube channel. Now, I've done some testing on this too to make sure it all works. Visit the YouTube channel. Visiting the Outlier YouTube channel, visiting my YouTube channel, that gets you one entry every day. Of course, you can't subscribe more than once, so you'll get one entry for that. And then we're going to have secret codes. I'm really excited about this. We're going to have secret codes. It's not rigged, Dormith. We're going to have secret codes. So for every day during next week, I'll be telling you a secret code. And you will need to go in and type in that secret code on that date in order to get that entry. And I think I'm gonna increase those entry values because you're gonna have to be on it. I'll give you a hint. They're not Batman. No, none of them are Batman or Joker. I thought about it. Or maybe they are. Some of them are sharing some posts on Twitter, basically just retweeting what some things we put out. Some of them are visiting the Outlier Instagram profile. And of course, leaving us a Google review. So there's going to be a lot of steps involved, but that's because we want you to share it as much as possible. And like I say, the winner for this is going to win $1,000 and a free year of Outlier. So I feel like it's definitely going to be worth your time. I'm really, really, really excited to share that with you next week. And so, of course, go ahead and subscribe if you haven't already. Now, there's no trades for me today, but let's take one last look at the market before the weekend. Holy moly, down 5.75% right now. This is crazy talk. This right here is an opportunity to just sit in cash and don't F up. That's one of my phrases. I hadn't had a chance to say it all that often lately, but sit in cash and don't F up. Will there be opportunities to short? For sure. I didn't take any, unfortunately, and that's okay. I have no FOMO. Right? I'm looking at this and I'm like, whew, that's brutal. But also keep in mind, there will be a bounce. There will be a bounce. And it might be a bounce that's up 9% the next day. It's very possible. It happened during COVID a couple of times. The biggest rallies happened in bear markets. Go Google it. The largest rallies of all time happened during bear markets. I wouldn't be at all surprised to see that happen in the next couple of days. And then we're going to see everybody saying, it's over. Buy everything you can. But you, as a smart, sophisticated investor, will know when the trend is over. We don't know what date. We'll know when it's over. When the 10 is over the 20, prices over the 50. This is what you need to be looking for, right? So go into the weekend with no stress whatsoever because you are an outlier, because you understand how to save time, make money, and start winning with less risk. What we do here for free on YouTube is better than most people's paid courses, and I do it twice a day. And the way that you can pay me back is just by telling everybody you know, okay? That's easy as it comes. So if you're an influencer of any size and any niche, we want to work with you. And come back on Monday, where outliers like us will continue to save time, make money, and start winning with less risk together as a team. Now, YouTube is going to pop up a couple recommended videos. I recommend you watch one of them, and I recommend you have a fantastic, amazing, stress-free weekend.